Dick's Sporting Goods just made its biggest move yet, a $2.4 billion acquisition of Foot Locker. But what does this mean for the retail landscape, for investors, and for you? Is this a bold power play or a desperate grab? Let's break it all down. In a time when inflation is high, tariffs are hitting hard, and consumer habits are shifting fast, Dick's just dropped a $2.4 billion bombshell. Why buy a struggling sneaker brand now? And how could this transform the future of sports retail? The answer might just surprise you. So here's the deal. Dick's Sporting Goods is paying $24 per share in cash to acquire Foot Locker, a massive 90% premium compared to Foot Locker's previous share price. Alternatively, Foot Locker shareholders can opt for 0.1168 shares of Dick's stock for every share they hold. This move isn't just about buying a brand, it's about going global. Foot Locker has over 2,400 stores in 26 countries. For Dick's, which is heavily US focused, this is a passport to international expansion. You might be asking, why buy now, especially when Foot Locker stock is down nearly 40% this year? Simple. Timing. Foot Locker was hit hard by Trump's proposed tariffs and pricing shifts from big brands like Nike. But with Trump pausing many of those tariffs, especially with China, Dick's saw a narrow window of opportunity. In short, they're buying low, with hopes to sell high in the future. Dick's isn't just buying Foot Locker, they're planning to keep it as a standalone brand. That means Foot Locker, Champs Sports, and all its stores will continue operating under the same names, just with new management and support. It's part of a larger trend. Dick's is investing in mega retail concepts like House of Sport, huge stores with batting cages and athletic fields. Combining this with Foot Locker's streetwear audience creates a complete customer pipeline. From sports enthusiasts to sneakerheads, Dick's wants them all. For investors, this is a high-risk, high-reward play. Here's why. Checkmark. Dick's gets global reach. They gain 2,400 new stores. They acquire a new demographic, urban, youth, sneaker culture. But they're also taking on new debt to finance the deal, and betting on a turnaround for a brand that's been losing its edge. Foot Locker's CEO Mary Dillon brought digital expertise from Ulta Beauty, and that transformation is still underway. Dick's may accelerate it, but it's not guaranteed. Foot Locker's stock shot up over 80% after the news broke. Dick's? It fell over 16% in early trading. Investors are cautious. Why? Because big acquisitions come with big risks, and this one is unproven, yet promising. It echoes a trend. Skechers was just bought for $9.4 billion by 3G Capital. Consolidation is heating up in the retail space. So what should you do? If you believe in retail innovation and international expansion, Dick's may be worth watching. If you're more cautious, you might wait to see how integration unfolds. One thing is certain. Dick's just made a $2.4 billion bet that could reshape the sports retail world. Hit that like button if you learned something new, and don't forget to subscribe for more finance and stock market breakdowns. This is Cash $4 signing off.